Hello and welcome back to Money, Mortgage, Moving Out. I'm Sam and this is Pip.
Hi!
And today we are going to be talking about tax.
As tax is such a big subject, we have decided to split it into 2 episodes.
This episode will outline the basics of tax. Income tax, the personal allowance, national insurance, tax reliefs and allowances.
You know that you need to pay tax, but what do you actually know about paying tax?
To understand tax, you must first understand the budget.
This is where the Chancellor of the Exchequer works out how much they're going to charge us all and exactly where that money is going to be spent.
The tax system is inarguably very hard to understand, and chancellors love to make it like this so they can hide how much we're actually paying.
Trying to get your head around the main taxes that we pay and whether they're actually due can save you a lot of money.
There are a lot of legitimate ways to avoid tax, and some are actually promoted by the government.
Tax evasion is illegal, and that means not declaring what you earn on your tax return. Tax avoidance is the non-illegal but sometimes dubious one. For example, having an account in the Cayman Islands.
However, there are completely legal tax reliefs and allowances that are in place to encourage you to do certain things that society values.
Like save for a pension, start a business, get married, raise a child, cycle to work, drive a low emissions car, donate to a charity, rent out a spare room or care for an elderly relative.
Some reliefs and allowances are automatic, but if you don't know about the others, then you might not get them. So every year, people miss out on valuable benefits.
Her Majesty's Revenue and Customs, or HMRC, is not going to check what you're entitled to, or that you're paying the right amount of tax, or you're paying too much tax.
You will, however, be chased if you aren't paying enough tax.
In this episode, we will outline the taxes that you are most likely paying and the reliefs that you're going to want to make the most of.
It's important to understand that before we start, many taxes and allowances start at a specific time of year, known as the tax year. And this starts on the 6th of April every year until the 5th of April.
Income tax and the personal allowance. Most people pay income tax on any money they earn. The majority of working age people earn their money through a salary, but some also receive income through renting out a property, returns on savings and investments, and also any profit from businesses that they run. The tax is known as a progressive one, which means the more income you earn, the more tax you'll have to pay. Whereas some taxes like VAT are not progressive, as everyone pays them at the same rate, and this means that lower earners pay a large proportion of their salary to these taxes. Income tax is based on 3 thresholds, or as they are known, marginal rates. Basic rate taxpayers owe 20% tax, higher rate taxpayers 40%, and additional rate taxpayers 45%. These percentages plus the income bracket that they belong to are set by the government and can be changed on a political whim, though they rarely are. Everyone has a personal allowance, and this is the amount of money that you can earn before you pay tax. This is also set by the government. In the year 2020 to 2021, the allowance is $12,500. That means you owe no income tax at all until you earn $12,500. Most people make the mistake that basic rate taxpayers pay 20% on all of their earnings, and higher rate taxpayers pay 40% on all of their earnings, but this just isn't true. Those that earn above $12,500 but below $50,000 pay 20% on the difference. So basically, if you earn £20,000 a year, you'll pay 20% on £7,500. This is the difference between $20,000 and $12,500. So the higher rate taxpayers who earn more than £50,000 will also pay 20% on the sum on the personal allowance £12,500 and the higher rate threshold of £50,000, but then 40% on anything above that up to £150,000. Those who earn above £100,000 do, however, lose the personal allowance incrementally. It is reduced by £1 every £2 you earn over £100,000. Additional rate taxpayers pay 20% on anything they earn up to £50,000. 40% on earnings up to £150,000 and 45% on anything they earn above £150,000.
National insurance. It's not actually a tax, but it may as well be because you have no choice whether to pay it or not if you are working. It's actually a social insurance scheme in which, while you have a job, you pay into a government fund that goes to compensate you if and when you don't work. A slice of the national insurance contributions pay for the NHS, and the rest is a national insurance fund which goes mostly towards state pensions, unemployment benefits, statutory sick pay, maternity allowance, and so on. The national insurance is essentially a pay-as-you-go. The contributions that you earn go toward people that are needing state benefits immediately. There are different classes of national insurance depending on your employment status, and you pay varied percentages according to how much you earn. The percentages are calculated through your gross pay, which is the amount you receive before your income tax is deducted. If you have an employer or are self-employed but you have a boss, you are a Class 1 national insurance. Bosses have to pay employer national insurance contributions for their workers as well. As with income tax, there is a threshold under that you do not have to pay your national insurance, which is £9,500 a year, true to tax year 2020 to 2021. You pay 12% of your earnings to the threshold up to £50,000. On any earnings above £50,000 a year, it is 2%. If you are self-employed, then there are two types of insurance, Class 2 and Class 4. You pay Class 2 as a flat rate of £3.05 per year as of 2020 to 2021. You pay a Class 2 of £3.05 a week, true to 2020 to 2021. You can choose not to pay this if your profits are below the threshold of £6,205. If your profits are above £9,500, you have to pay Class 4 contributions, which amounts to 9% of the profits between £9,500 and £50,000, and you pay 2% on anything over that. You may want to pay voluntary national insurance, which is known as Class 3, if you are unable to work for a period of time. You need a certain amount of national insurance contributions for some benefits. These cost £15.30 a week, true to 2020 and 2021.
Understand your payslip and tax code. PAYE stands for pay as you earn, and this is how you pay tax if you're employed. Your employer will pay income tax and national insurance to HMRC before you receive your salary. How much that is set out on your payslip. A payslip is essentially a receipt for your earnings, income tax and national insurance. Your payslip states your gross and net pay. Your gross pay is what you receive before tax, and this is generally what you would consider to be your salary. Net pay is what goes into your bank when income tax and national insurance have been deducted. Your P60 is a form that you receive at the end of the tax year, and it outlines your total pay, your total income tax and national insurance deductions. Your P45 is a form that is issued if you leave a job, and it shows how much tax you've paid in that year to that point. You keep part of it and give part of it to your new employer. You are assigned a tax code by HMRC and it appears on your payslip. This is a code that indicates to your employer how much tax to deduct via PAYE. You should check this, as especially when you start a new job, as it is your job to do so. You may be put on an emergency tax code. This usually happens if your new employer hasn't got your P45. Most emergency tax codes end in M1 or W1, and this means you'll be taxed either monthly or weekly instead of annually. It may end in OT, which indicates that you do not get a personal allowance because HMRC does not have enough information about your income. You will most likely be on a tax code that ends with an L, which applies to those who have one job and claim no taxable benefits. Generally, the rule is that you multiply the number in your tax code by 10 to get the amount of money you can earn each year before you get taxed. Your payslip will also detail any pension contributions and deductions and student loan.
Tax reliefs and allowances. Tax reliefs are the amount of money for certain things that the government likes, that you can deduct from your gross pay so you don't have to pay tax on them.
Pensions. Any money that you pay into a pension product, that can be a workplace pension or a private pension you've set up yourself, is tax-free.
Charity giving. Some companies offer payroll charity giving schemes, or give as you earn, where your contribution is taken off your gross pay, so that you do not have to pay tax on it.
Rent a spare room or Airbnb. If you are fortunate enough to own your own home and you want to rent out a spare room or put it on Airbnb, you can earn up to £7,500 in rental income before you have to pay tax. Although from April 2019, this is only the case if you are around for at least some of your Airbnb guests stay. You can also earn up to £1,000 from your property, for example, renting out your driveway or parking space.
Cycle to work scheme. You can save as much as 42% for higher tax rate payers and 32% for basic rate taxpayers on a bike to use to get to work on the Cycle to Work scheme. Your company pays for the bike and you pay them back in increments as a salary sacrifice. So the money comes out of your gross pay automatically. That means you are not paying tax on it like you would be if you bought the bike out of your net pay.
ISAs and the personal savings allowance. You pay income tax on income that you earn from your savings. For example, on interest earned on a cash account or dividends from an investment. ISAs are savings account to which you can save a certain amount per year. Any interest earned on cash ISAs or any investment returned earned on stocks or shares ISAs is tax-free. There is a personal savings allowance. This is a sum of money you can earn on any type of savings accounts before you have to pay tax.
Investment returns. If you invest outside of an ISA, you are liable to pay tax on profits you make, income tax on dividends, and capital gains tax on any rise of value in shares you sell. You are likely to have to do so though, as you have a generous yearly capital tax allowance.
Marriage allowance. The existing government rewards couples for being married with tax breaks. The marriage allowance can save you £238 a year, but few people claim it. To qualify, one of you in the married couple must be earning less than the personal allowance in a particular tax year. So that means not paying any tax at all. The other partner must be a basic rate taxpayer. The earning partner can transfer £1,190 of their personal allowance to their spouse, which reduces the earning partner's tax bill. This is a good perk, even if you are only temporarily under the personal allowance. This came in April 2015. If you were eligible back then but you didn't claim, you can get backdated payments. When you are married, you can share income. So if you have lots of savings or you have an income for a property, for example, and one of the couple earns less than the other, as in one is a basic rate taxpayer and the other is a higher rate taxpayer, you can juggle your assets so that they are in the name of the basic rate taxpayer and therefore take advantage of a higher personal savings allowance.
Childcare. Parents can claim up to £2,000 a year per child under the age of 11. or £4,000 for a disabled child that is under the age of 17 to pay for childcare. To qualify, both parents must be working and earning at least £125.28 a week, and no one partner can earn over £100,000 a year. Self-employed people can also take advantage of this, as there is no limit for freelancers. You have to register and open an online account with the government to get the allowance.
We hope that you have enjoyed this video.
And don't forget, this is just the first half of tax, so stick around for next week's video to learn a bit more about it.
We would really appreciate it if you could like this video and also subscribe to our channel.
And also if you could follow us on TikTok and Instagram at Money Mortgage Moving Out. But for now, we'll see you next time.
Much love!